Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsors and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's conversation is with Lou Grabowsky of Juniper Capital Management. One of the things that we talk about early in this episode is how Lou and his son, his co-GP is his son, got Juniper going. They took investment from investors not just in the form of a fund, but actually at the management level of Juniper. And so we explore that a little bit and how that has had ripple effects here more than 10 years on. Those investors, many of those investors at least, did eventually also become GPs in the fund proper. And they continue to be involved, Lou pointed out. But there was an interesting sort of origin story structure there. We pressed Lou on it a little bit. He demurs. He says there's some secret sauce there, but we do get a sense, and it's a little bit different than what we're used to hearing from early sponsors. Any reaction to that observation, guys?
Yeah, I mean, I think there's just multiple ways to get going in private equity or independent sponsorship. And this is one of those hybrid methodologies, it kind of sounds like, that they came up with to raise some capital up front to establish the team. And in doing so, they gave away potentially some economics. But ultimately, I think any independent sponsor or private equity professional at the onset is just trying to build momentum. And that takes capital and it takes a track record. And here it's an interesting strategy where this initial fund gave them the runway to build the team and to go out and actually deploy capital that they had on hand. And I think what they learned with that in doing that was that they could also pair that with additional outside equity sort of on a deal by deal basis to amplify that initial fund, which was probably not, I don't think it was, really large by traditional PE standards. But I think, that's kind of what all of us in some ways are trying to do when we're not starting with, an unlimited war chest. We're trying to put our capital with other capital to build portfolios and invest in multiple opportunities as opposed to just sort of putting all of our chips into one deal. So I think, raising up front and then having that optionality to go deal by deal was, if not intentional, was a pretty smart way to do it. And but in doing that, they've also recognized that there's power in this deal by deal investing, and they're not necessarily committed to just deploying their own equity.
In case listeners are a little bit curious or confused by their model overall, because we hear them talking about their funds. So are they traditional private equity or the independent sponsors? One of the things that we didn't touch on super directly, but we know because we know them, is that as you just kind of implied here, Max, they have dry powder, but they also raise additionally deal by deal. And so we've talked to them about a number of their deals. They show up at McGuire Woods. So they are definitely one foot strongly in the independent sponsor ecosystem. Nicholas, I think you helped me understand their structure a little better. Maybe you want to flesh it out?
Yeah, I think when we hear about independent sponsors, the conventional wisdom is that you have someone who starts fresh with nothing and they pay all the working capital themselves until they get to their first closing. And for that first closing, they raise all the capital from outside investors and contribute minimally, if anything at all, to the deal itself. Now, we've heard different variants of this on this podcast, right? So we had a few episodes ago, we had an arm of a family office, and the family office was the starting capital for any given deal, and then they raised outside capital in addition to that. You have some independent sponsors who are a little bit more seasoned. They've been around for a little while. They've had some liquidity events, so they're able to put, call it $1 million into a deal of their own money, so to be a minority LP as well. And in this case, it's a hybrid version where not only did they raise some upfront capital to build infrastructure and get going on day one, 11 years ago, but they also are raising now a fund, which I think is at least the second one, which is not meant to cover the entirety of each deal, but gives them a starting point for the fundraising. And so investors into the fund will have a position in each deal that they do. And then to top that out and to amplify it, as Max said, they raise capital on a deal-by-deal basis. And that's, of course, how we met Lou and his team as we've been looking at some of the deals that they have been working on. I think a crucial piece and why this is beneficial is when you go to business owners, it's really hard as an independent sponsor, and everyone listening will know this. When you go to them and you say you have no capital, it's just the highest barrier of entry that exists in our ecosystem. And so to lower that barrier, to be able to go out and say, yes, we have a committed fund, a seller will hear that as, oh, they have the capital accounted for, even if that is only 30, 40, 50% of the final cap stack. A seller will hear that as, oh, this is a high likelihood of closing. So it really helps in converting those conversations into real LOIs that you can work on.
Well, before we turn our attention to the interview, a reminder that here at Minds Capital, we invest equity into independent sponsor-led acquisitions. Our check size is $1 to $3 million per investment, and we do about an investment per month. So if you're a sponsor raising equity for a platform acquisition, submit your deal to us at mindscapital.co. Or if you're interested in investing in Minds Capital as an LP, there's a pre-registration form also on our website for investors. If you are accredited or can become accredited, fill out that form to be kept in the loop on future raises. That is mindscapital.co. Okay, here is the Minds Capital podcast interview with Lou Grabowsky of Juniper Capital Management. Welcome to the Minds Capital podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Independent sponsors need a legal team that understands the model and knows the players. Platt Richmond, a Dallas-based boutique law firm, has deep experience in guiding independent sponsors through the complexities of their acquisitions. The team at Platt Richmond provides support on all aspects of your transaction, from structuring and diligence to financing and securities compliance. They also represent stakeholders throughout the ecosystem: capital providers, lenders, family offices, sellers, management teams, which gives them a unique 360-degree perspective on the sponsor model that ensures a seamless process for your transaction. Partner with Platt Richmond to focus on what you do best, finding and executing great deals. Visit plattrichmond.com today to learn more. That's Platt with 2 T's, Platt, Richmond.com. After 30 years in accounting at Anderson and Grant Thornton, Dallas-based Lou Grabowsky founded Juniper Capital Management with his son, Brian, about 11 years ago. Lou leveraged his decades of strong relationships to build credibility with sellers, and that network also provided the initial working capital in exchange for GP stakes in the firm. We're going to hear all about that. Juniper has made 12 acquisitions across 4 platforms. They've exited those 4 except for part of one of the platforms. And the next step in Juniper's journey is to raise a fund to continue to deliver on the strategy that has been so successful to date. Lou Grabowsky, welcome to the Minds Capital podcast.
Thank you. Good morning, guys.
Lou, this GP, the stakes in the GP that you all, the structure that you did back in 2015 when you first launched the firm. Let's get into that a little bit. It's a little unusual. Please tell us about it.
Yes. Can I just calibrate a bit of your intro, Will, on this?
Sure. Yeah.
Yeah, I would say, first of all, I wouldn't call it necessarily GP stakes. That might be your words for it, which are fine. But it was an investment by several investors in helping us to do what we had talked about before, is stand up our management company to be able to build an infrastructure to hold a private equity firm with people and process and the ability to have the professionals around us to provide the diligence and the advice as we went forward, and then also to provide the initial capital to put into a deal. So I would characterize it as investors that we brought in to help us stand up our management company and build a strong infrastructure. And then on the deal flow, we did do 12 acquisitions over 4 platforms, and we actually, again, I would say we have exited 11 of those 12 acquisitions. So with that, that also I believe answers your question about I wouldn't call it unique, but it certainly served us well in how we attracted the original investors to our fund to help us do what I indicated. And if I take that further, what that allowed us to do is really provide the confidence in the founders and sellers that we were dealing with, that we had the ability to execute and close on a deal. And obviously, it provided us the initial capital to invest in that particular situation. And then along with that, those original investors co-invested with us on the deal specifically as LPs, and then we were able to attract even others. So actually closing the deals in providing the capital to do the 12 acquisitions we did on the 4 platforms actually was a pretty effective, efficient process, and it emanated from how we originally established the foundation of our firm.
But Lou, just so a little bit more on these initial investors who, as you said, provided capital to allow you to stand up the firm, the infrastructure, the foundation. Right. Wouldn't the typical model, though, be that the management fees would pay for all of that? And so in this case, there was something above, something extra beyond the typical model? I mean, isn't that what management fees are usually for?
Yeah, we dealt with management fees separately, and it came into our formula, Will, which was actually a special formula, and I think it was unique that incorporated the concept of management fees and how we dealt with that relative to our initial investors. Part of the secret sauce, Will.
I see. Okay. Is it a structure that you recommend to others? This was your inaugural fund. It's now been 11 or 12 years. Has it played out the way you intended at the time?
Actually, it's played out beyond probably what we expected, but let's just keep it that it achieved our objective. And yes, I would highly recommend this because what one needs at that stage and what it gave us is the ability to convey confidence into sellers and founders in that we were a well-founded company, well thought out people process, and the ability to commit to a deal, if you will. And so, yeah, and what we gained through that process were investors who were in that original group who have been with us to this day and have come into our committed fund. They invested in, I would say 75 to 80% of them invested in each of our deals as LPs. And they, in essence, provided the confidence to others along the way that were just LPs in our deals going forward, that if they're in it, then I should consider being in it. These were really quality investors, which is another attribute that we try to align with.
Going back to how your initial structure conveyed heft and gravitas maybe to sellers, often it seems like what sellers care about is just ability to close. Is there real capital? Are these guys, do they actually have dry powder? Do they actually have capital to close the deal? You're talking about that. And you're talking about that and sort of all the trappings of a firm. And your sellers saw that and saw that just that there was even more than access to capital. There was an actual true infrastructure firm at work here. That's what you mean?
Yes, and more actually. What the what we offer is beyond the economics, frankly. Uh, our our objective really is to find deals that aren't being auctioned, which are getting more difficult as time goes by, as you guys can relate to. And so uh, we find our way to have direct communication, almost in all cases, with the seller and founder. And beyond the confidence in providing, in procuring, and making available the capital to do a deal, founders and sellers in this middle market to lower middle market category, come into a relationship with skepticism, if you will, around private equity, which I imagine you guys can relate to. Our motto, and the word you used was gravitas. I would just say it's a combination of experiences that we bring to the table and the understanding of relationships and the understanding of partnerships. And our MO is to establish a partnership with sellers and founders that we ultimately transact with, and they pick this up in the early conversations we have with them. And so I would say that certainly the infrastructure, the sturdiness of the firm, the foundation of the firm, the capital is important because those are gating issues. If you don't have the capital, obviously you can't execute on the deal. But what makes the difference oftentimes is whether there's a trust established and a confidence established and a desire to work with each other. And I would say that is what was part of the formula.
So when you started, you brought on investors at the Juniper capital management level in order to build out the infrastructure. How does that pitch go to them? Because this is before you have really started generating deal flow, right? And it's quite different from raising capital for an actual deal or an SPV on a deal-by-deal basis. So how does that pitch go, and what's in it for them, and what are economics that for a deal, we know you want the 3x MOIC on that when you present it, or high 20s or low 30s on an IRR basis. But when you're investing straight into the GP, is it different then?
I don't want to oversimplify this, Nicholas, but it gets down to confidence in the thesis that we have to execute the junior capital strategy, confidence in us individually, and the identification of actually how we're going to do it. And these investors, these original investors, were relationships that both Brian and I had across the country and frankly around the world in certain cases. And so it wasn't like these were, relationships that just started. They had been in place for years, and they understood what our careers were, what our experiences were, where we were headed. And frankly, it was as much about the two factors that I referenced to founders and sellers a few minutes ago, as it was to stand up the firm. We had great confidence that we could execute on what we said we were going to do, and they would share in that to a certain extent. And it really was not a difficult process. We have many significant family offices in our investor group here, both in the original fund and as we go forward, continuing. And that's that's an important part of our our group.
Right. And so because these relationships were established and you were able to convey to them upfront, here's the independent sponsor model or private equity model. We are going to be pursuing this now. You know what we've been up to and what we're capable of. And in exchange for X dollars, you can get X% of the GP entity here. And as we build this firm out, that helps us kind of kickstart things on our side, and also helps us on the credibility side because we have a broader base of support. And for you guys, you now own a stake in not just one deal, but in the broader GP entity.
That's correct.
And so,
you remind me of another aspect of this, is that those original investors provided more than capital. They provided skills that were available to us and accessible to us. We do not push service providers on our portfolio companies. However, if we have the talent around Juniper Capital within our investor group, because of our relationship with our investors, they are quick to, eager to, and supportive of providing that expertise advice to our portfolio companies. So we have real estate talent in our investor pool. We have risk talent. Certainly we have legal talent. We have operating talent. And so we've got skills that we can call on and have called upon when needed with our portfolio companies.
Newly acquired and PE-owned companies are high-value targets. Hackers time their attacks when teams are distracted by the deal, exactly when a breach can stall operations, bleed cash, and blow the thesis. Inzo Technologies is your full-service IT MSP for post-close stability. They assess your target, surface the biggest risks in plain English, and give you a day 1 through 30 plan to cut exposure, prevent downtime, and even find cost takeouts like bloated telecom bills. Check out inzotechnologies.com, INZO, or email CEO Nick Akers directly at nick@inzotechnologies.com. Having acquired Inzo himself, Nick understands the challenges sponsors and searchers face when transitioning a business. So make sure to tell him you're an independent sponsor and listener of the Minds Capital podcast. nick@inzotechnologies.com.
So it's quite analogous in many ways to the traditional search fund model where they raise capital to search. But in that case, the deal flow actually is owned by the investors, and there's a little bit of a different principal agency dynamic at play, versus here, you guys are very much in control and they are on for the ride, and they provide capital and some expertise, but they're really buying into what you guys are establishing as opposed to it being more of a controlled form entity. For someone starting in 2026 as a new independent sponsor, how much should they raise if they go this route? And what are the things that you would invest in as far as building infrastructure right out of the gate?
It's hard to say what anybody should raise in this circumstance. What I would say is it has to align with the plan. When we put this together, we had a plan, we had a forecast, we had an estimated time frame when we would make investments, how much capital we would put in those investments, where the capital would come from, and when we saw a build strategy, how that build strategy would go, and when an exit would occur. So it's not just a number. It's a number that's the consequence of a thoughtful thesis and process and forecast. Obviously, there are projections at the start of it, but it takes it takes a substance to do that. This is not just, picking a number as I know you guys wouldn't think it is. But that's what I would recommend to individuals that are just getting into this business today. Uh, you know, you have to have a realistic plan that aligns with what you bring to the table, which is yourselves plus capital plus any other unique features of your offering. And then that's got to be played out. And then you have to kind of report against that. And our investors are close to us and they're from historical relationships. On the other hand, these are these are business partners with us too. This is a business. Is not a hobby. This is not where people are just not expecting, the right returns, the right performance, the right reporting. I mean, you have to have those ingredients, as if you've been in existence for some time, and we prepared for that. Brian was well prepared and well steeped in experience in what major funds do and what they need to have. And I brought, the senior experience, the seasoned experience, having been through a number of different aspects in my career that provided the confidence and the relationships to move things forward as I really learned the business over these 11 years, having not been in it directly.
But I think a lot of people would think about this as, okay, I need to raise enough networking capital to get me to the point of the first deal, upon which I get a closing fee, which is most likely rolled, but I also get the management fee. So from there on after, I can pay my bills. So they're trying to budget for how much cash do I need to get to that point, be it 6 months or 3 years. Is that the wrong way of thinking about it? Is it more multi-layered than that? And if so, what would the other dimensions be?
They're actually what I mentioned, Nicholas. Yes, it's multi-dimensions. It's more than paying the internal bills of the private equity firm. It's to procure the capital that you need. It's what investments are you going to make? What are the size of the investments that you're projecting to make? What is the hold period? And what is the expected exit that you would have? And so I realize it's all projections and best estimates at the time, but then that aligns back with having a strong thesis in what type of entities you're going to invest in, where you're going to find them, what industries, and how long is it going to take to close a deal, and so on and so forth. So it is multi-layered.
Lou, back to the thesis and also what you touched on, the complementary, what you and Brian,
Right.
how you complemented each other, what you brought to the table. Say more about that and your partner in this, your co-GP, and what he brought. I think we have a sense of your depth of experience. What was Brian's contribution, and how did it work with what you brought?
Brian, at the time, had somewhere between 12 and 14 years of experience. He had begun with a major global professional services firm, did that in the accounting and audit practice for a short period of time, worked his way into what he really wanted to do was transaction services, and learned it from the professional service side, which is a good side because that provides a dimension that many people might not have initially, which is a kind of a risk assessment, a assessment on operational impact and the effect on deals, and dealing with clients on the buy or sell side of that. But he spent, I don't know, several years in that. Then he moved to an investment bank because he wanted to get into that dimension of the business, and spent a number of years there. I'm unclear on the years, maybe 3 to 4 in that situation, and then decided he wanted to get another view of the transaction process of joining a private equity firm. We spent 4 to 6 years. And when I then retired from Grant Thornton, we teamed up, and Brian had he had both the hard skills and the soft skills, which which is what you really need in this business to bring deals over the line, frankly, in the right way. And so he just understood the business really well from all dimensions, and that with the experiences I had, um, the decades of management responsibilities in the firm, leadership responsibilities, governance in many cases, both in the firm and sitting in board meetings for a number of years and dealing with significant issues across the client base, allowed us to form, frankly, and I say this humbly, a pretty effective team. Uh, there were there were not many situations where we wanted to do a deal that the seller and founder didn't want to do a deal with us. Few, of course, and many we didn't do because of things that arise in the diligence process on either our side or the seller side. But that was Brian's background. That's what he brought to the table, which was significant. It's only matured and gotten more seasoned further in these 11 years together. And now we've added a couple senior resources to the team. So kind of we're off in our now committed fund um, in a major way.
I often talk about how people don't sufficiently appreciate the value of diversifying when you have a partnership, the age and kind of your tenure and experience set, right? And so you and Brian are a couple of decades apart, I believe. And so what is your perspective on this? Because you see so many private equity partnerships start with 2 or 3 guys who are the same age. They met in college, and so they're at the same stage of their life and career. But from your perspective, having experienced and lived now a partnership with more of a generational gap, how does that contribute, and how valuable is that?
Um, what's extremely valuable, I think we had a head start on it because we're father and son, right? I mean, that could be plus or minus. I kind of get that. Uh, and if you don't have that, it could be plus or minus. So who knows? But I'll just speak about our situation. I think it was important, frankly, for me to lean in further to learn from Brian the business on the more operational and technical sides of what makes a private equity firm successful. And so, you have to recognize that, and I leaned in and probably learned a lot more from Brian, adjusted more to his style than mine, even to this day. But it worked because obviously there was respect and a compliment to what I brought versus what Brian brings on a day-to-day basis. And we close that gap, so to speak, that you referenced with both leaning into each other. But I would say I had to lean in more because I wasn't a student of this industry. I was a student of another industry that touched upon it, serviced it, and engaged with relationships in it. But until you're really in it, you don't know the nuances of the business because every industry, every segment has nuances, and Brian knows those. He's
And so
really
you're
pretty good at it.
And so you're talking about the nuances between you having spent a career at Arthur Andersen and Grant Thornton in professional services. So you've interacted with private equity buyers for all this time, but you haven't been on that side of the table. And so that for you was a shift. Can you talk a little bit more about that? Was it difficult, or did it happen pretty organically and quickly?
Um, I think it continues to happen. To be very honest with you, Nicholas, it's an evolution. I mean, when you're in business, you're this is a simple example. When you're in business, your focus is on essentially, when you the businesses that I came from, it's primarily on net income, earnings per share when you work with public companies. You get into this business of private equity, and the whole model flips around. It's on cash flow, which is obviously important to any business, EBITDA, and you you uh, you get into enterprise value, and then how you determine a offer price based upon the enterprise value and the different components of role of seller equity, what the what the debt leverage ratios ought to be in a certain situation. You get down to really the true technical aspects of putting a deal together, and you get into the modeling aspects of it and the remodeling of a deal. I mean, those are all gating issues. If you do not know, if you do not understand that, and if you do not know how to do that, then you're at a huge disadvantage. Brian brought all that to the table. I had to, I'm not the model guy, that's for sure. I haven't gotten into that stage of doing that, but the rest of it, I've learned, and I've learned the nuances of those aspects just in that set of example, Nicholas.
We recently had a guest who had spent a career of 15, 20 years as a QAV provider in the Dallas area. And he made the point that he, of course, knew how to run a QAV and knew kind of all the red flags and yellow flags to look for in a due diligence process. But he also made the point that his experience set was really, really broad. Because as a service provider, you're not only working on one deal or, a small handful of deals on a yearly basis. You're touching a very, very high number of deals at any given point. And so within a decade or two, your experience at the number of industries you've seen, the number of businesses you've seen go well versus poorly is very large. And so that data set of experiences made him, in his point of view, a very effective independent sponsor. Does that resonate with you?
Very much so. And it reminds me of what Brian brought to the table when he was with his private equity firm. Brian had an opportunity that many young private equity individuals might not necessarily have, and that is to be responsible for major pieces of a portfolio deal from beginning to end, and being left in many cases or being asked in many cases to run the deal. And that enabled him to learn how to work more with the seller founder, where there were, in many cases, decades apart in experience, and bridge that gap. And so, yes, he brought that to the table that was extremely important to us moving forward.
And the other thing you've done, of course, as a professional service provider is to sell, especially when you're senior like you were. You've sold yourself into business owners and managers that, hey, we can do this project for you. You've gotten into conversations and you have converted them into sales. So that is also analogous with being a private equity buyer, where you really want to start the conversation, and that's the key.
Well, there are a couple of things that you trigger in my mind coming from professional services, which I did. First of all, in order, you can characterize an auditor or an accountant with green eye shades or anything you want along that path of description. But the great accountants and the great auditors kind of understand business, and they understand the consequences of business decision on the economics. Uh, and in order to really get a full scale view of what's happening in, let's say, your audit client as a partner, you have to understand how the leaders think, what their plans are, and how that translates to, if there is a board, which there always is in a public company and most of the times in a private company, how that is communicated at the board level. Because if you can't understand what the leaders are thinking, then you're not going to understand why actions are taking, what the consequences of those actions are. And every action has an economic impact. That's what's so critical about a finance role in a company. Like it or not, everything has to go through it. When you need the money to do something, it has to go through it. And so that's why that position, if exercised and executed well, sees the whole business. And the auditor, to understand the consequence of decisions, that they have to kind of understand that, and they have to procure the trust and confidence of the leadership to convey that information to them. Because in my experience, CEOs oftentimes don't even tell their team what they're thinking, and they don't complete the story for their team. And another aspect of auditing and professional services is you have to understand risk, because you focus your attention through those services you're providing on risk, and how is the company managing that risk? What are the mitigation aspects to lessen that risk? And you get that into your mindset. And in private equity, that same thing carries over, whether it's a Q of E or whether you're doing due diligence. But recognize that the reciprocal of risk is opportunity. And so if you approach it that you're managing risk to create an opportunity, it's a total different kind of mindset than saying you got a risk and everything is a death march and everything's spiraling downward. That's not how we think of risk. You have to manage it, of course, but if you can manage it and you're doing the right things, then you have opportunities that others might not have. Maybe more than you wanted to hear, Nicholas, but that's how I kind of align the professional services business and the attributes and the strengths that provided me and to a large extent Brian in his early years, and how that translated into the private equity business.
And what you mentioned there at the end between the link of risk and opportunity, I think you made this point in the pre-call as well, that the two of them go hand in hand. So if you're looking for a risk-free deal, it'll also effectively be opportunity-free, I think, paraphrasing the point that you made at the time. Can you elaborate on that?
Yes. The only factors that you have to be careful with in making that alignment, which I always make because I believe in, is you can't accept bad actors. You can't accept obviously activity that's not appropriate, that's not legal, that's not ethical. And if you caveat that you won't accept any of those conditions, then risk, if mitigated, can then produce whatever opportunity that you were seeking in when you found or knew about the risk that you were going to incur. So there's conditions around that, Nicholas. It's not just a simple risk equals the reciprocal of risk is opportunity. There's a factor up there that says this is how we look at it. On the other hand, there has to be some non-starters if you see them.
But I like it as a starting point that, put away the mindset of we don't want any risk or we want to minimize all risk, and shift to a mindset of, okay, we accept there will be some level of risk. These are the risk factors that we typically are more comfortable with, or that we are particularly well positioned to manage or create value from, and pursue opportunities that fit there. That, I think we've heard a version of the same, which is, I like hairy deals, and then whoever is the guest will specify what the hair is that they particularly like it could be a distressed deal or whatever it would be. But it's a mindset shift there, right? And as an investor and as an auditor, certainly, right, I would imagine that it's quite easy to take the position that we hate all risk, and that the more there is, the less we like the deal. But there is such a thing as no, risk is okay if it's priced in and we know how to manage that particular one.
Exactly. if you have no risk in a deal, then I'm not sure what value we're going to bring to the table. Uh, uh, Risk is actually a positive thing under the conditions that you and I are talking about at this point in time. And it also ties into another attribute of a business that we really search for, and that is businesses have to have solutions. Because if they're delivering solutions, that means that there isn't necessarily a quick answer to a matter that the target is executing against, and so as you're devising solutions, that brings about certain risk in just about all cases in certain things. So that aligns with this attribute we look for in a business, and that do they have a solution, or are they just a commodity driven enterprise? And obviously we try to align with the former.
What do you mean by commodity-driven enterprise?
They're just in essence picking up a product they're getting from somewhere else, or picking up a service they're getting from somewhere else and transmitting it on. And they have to have the ability to convince and sell, but they're not putting real skin in the game in fabricating the product, in developing the service, in innovating the service, and innovating the product. That brings about a whole different element of operation. And I'm not criticizing those businesses, because there are many good businesses and there are many profitable businesses. But that's just not our target audience, frankly.
Lou, we actually haven't gotten much of a flavor for what you do target, the profile of companies that you go after, whatever thesis Juniper is operating under.
We have three segments that we focus on, which would be industrial services, infrastructure, and B2B businesses. We like those sectors. Obviously, industrial is pretty wide open in terms of industry subsegments there, but it's gets into the solution aspect. It gets into, in many cases, asset-based businesses. We like to find businesses that can do that on an asset-light basis also, but often that isn't the case in the industrial companies that need CapEx to produce the product. Infrastructure, we sort of backed into, but really think it's obviously a significant opportunity for us. Ballard Marine Construction, our first investment, was a marine construction company that did underwater work for utilities and dam owners primarily. Infrastructure services was a rehabilitation of water and sewer systems underground, which was infrastructure. Our steel businesses are in the construction business, if you will. They were, and they provided that. And our precision platform was in machining, which very sophisticated aspects. And so all those businesses, to one or another, touched upon infrastructure. So that's a significant segment. B2B, I can't go into the details because we haven't announced it formally yet, nor has the company. But we frankly just closed a deal last week in our new fund that's a B2B business. Just an outstanding opportunity for both, we believe, the founder and the seller, and us. You'll be reading about that and hearing about that in the coming week or two.
And Lou, what was the backstory on that deal, given that, was that your first B2B deal?
You might say that, I guess. Yes.
And was it just that the opportunity came across, or had you developed a thesis and went out looking for something?
What we develop, this leads us into another part of our pre-meeting discussions on the business development aspect of Juniper, if you will. And as we go forward in the fund we're developing now, And I want to come back to that later on one thing you mentioned at the beginning, Will, but to kind of answer your question now, we looked over the past year to 14 months at over 1,200 deals. We have a business development function now that frankly is built the right way. It's built on having an individual who drives our business development process that's a business person, not just a sourcer of deals and someone to try to move a deal along. This person is someone who has a reputation in the industry, has come from private equity, was at the top of the game in the private equity shops that he came from. He has a following in the country that is strong. Now, obviously, most of those deals were dismissed pretty quickly in our thinking because they didn't fit. But, through that process to get to this deal that we just closed, this came up. And it was very clear after several conversations that there's really something special to this situation. And so that's really where it came from, and it fit the B2B model, which we wanted to get into. We're spending a lot of time in thinking about facility management businesses also in terms of a B2B on the commercial side. And so that's how that came about, Will. But our business development function has it's working on all cylinders now. And the person that we have leading it can source deals, can help us think about the alignment with our thesis, can think about the diligence aspects that we have to hit through the process, can stay with the deal, develops a relationship with the founder and seller, is a part of the deal team in many cases, and then can move forward as we, in our buy and build strategies, continue to seek add-on situations, and then move that to continue to move that to another level. We're pretty proud of our business development function now. There's a lot going on in the firm.
And is that business development function that sounds more expansive maybe than traditional, as you said, much more than just deal sourcing.
Right.
Did you all set out with that vision in mind of a much more expansive business developer, or was this individual just so good that that's what they imported when they joined the firm?
I believe it's the former. That's in a small shop like we have, there are four of us, right? And so you have to have talent that is multifaceted. Now, we will grow. We have plans to add several more resources over the next couple of years. But now we need all of us having multiple responsibilities in the firm.
Yeah.
And this situation is one that's really important. In my former career, there were two individuals that served in this role in professional services, and they executed similarly to what I'm suggesting here, that they stayed with the deal, they stayed with the client. They were critical in that client accepting the firm as its service provider, and they were important because they were business people, not just a business developer.
Lou, we only have you for a couple more minutes, but can we double click it on one of your deals and get a little bit of a case study from among the 12 and any lessons learned?
Yeah, I thought about that, Will, and I'd like to approach that this way because I think it would be relative to your audience most beneficial, rather than just drilling down in a deal. And it gets down to the lessons learned in our situations. And I think I certainly learned a lot from this along the lines that we talked before. In one of our deals, it was clear that we're not micromanagers here. We treat our portfolio companies as partners, the leadership as partners, and we're not trying to run their business, because I'm not sure why we would invest in it if we wanted to go run it. That's not our backgrounds. But there are certain times that you have to drill deeper on certain issues. And I think you got to be careful. You don't want to be a micromanager, but when certain things arise, particularly in these businesses that are project-based, construction side businesses, they could go sideways pretty quickly. And I think in one of our situations, there were certain risks that arose that we didn't necessarily drive and drill down as far as we probably should have, as quickly as we should have. That's one experience. Another lesson learned is that when you have a buy and build plan, which is what we generally have in each of our investments, then you have to execute on it, and you can't continue to just have discussions over it. You have to have a clear, aggressive strategy to do that, with obviously using good judgment as you do that. And I think in one of our investments, we didn't take advantage probably with the growth opportunities there. There were other factors that confused that, but you have to stay committed to that, and you have to take the risks that go along with that. In another situation, I would say that we might not have been quick enough to adjust to a change in leadership that we needed. And it's critical that you do that. And this relationship-based model, you got to be careful with it, because you could slip and not overlook, but give more kind of latitude to certain things that just aren't right to execute on the formula that you have. And sometimes you have to make those tough decisions to either move leadership into a different role or replace leadership. We go
Lou, let me interrupt you there. You because of the relationship-based model, that you were implying that because I guess you invest so much in relationships, it can make firing people hard. is what you were saying?
I think that's one way to say it, Will. Yes, because you have a close relationship. This is a business, of course, and you've got to return a return to your investors. And our investors oftentimes, most time, just about all time, include the rollover members in management. So, they're part of the stakeholder group too. You got to make the tough calls when you have to make them.
Yeah.
And, that's sometimes that difficult if it's the rollover members in that group. In our cases, we've got through that, frankly, pretty well, but could we have gotten through that quicker? Yes.
Yeah.
And I think in our last deal, we got most of these right. We took these lessons learned and applied them, and it worked out really well for us in our precision deal that we just completed on the exit a few months ago.
Lou, one data point that I noted here in our call was 11 years, 12 acquisitions, and 11 exits so far.
Right.
Are there some, lessons learned from, because this pace of exiting is quite impressive. Getting out of your deals is in many ways harder than getting into them. And so are there some rules of thumb that you are following? Are you willing to sell pragmatically when you go to market with these deals? Like, how have you accomplished such a nice outcome on the exit side?
Yeah, well, thank you, Nicholas. We're pretty proud of that also. And it gets down to the recipe of what we discussed previously, and to be pragmatic. And I would say that we could even be more pragmatic. One of the benefits of the first fund that we had was that we didn't really have a time frame on when we would exit, and that was attractive to investors also at the time, because they realized business isn't a straight line and you have ups and downs, and that you exit when you're ready to exit. But I would say in all of our cases, because of the confluence of our thinking, our trying to be realistic on an investment, our need to harvest when it was time to harvest, when the market was right, whether the market was right to protect our team in those companies in different ways, whether it was a full exit or they wanted to continue on with the acquirer, and just having, our boards of those companies that were really functioning appropriately, and then having investors that we might have counseled with, and understanding the industry dynamics, all produced our ability to exit our deals in a timely and, frankly, a very successful manner. And we're pretty proud of that. So thanks for bringing that up.
Lou, any final thoughts before we let you go?
Yeah, I just want to, the one calibration I want to make in the fund that we're continuing to raise it at the moment, our expectation, Will, is how we look at that is that we want to put over $100 million of capital to work. And that fund will enable us to do that in doing, the number of deals we think we should do per year and moving that forward. So we're looking at a much bigger situation than, what the fund size might be in and of itself. When you can multiply that, combine that with other capital, we feel we can kind of move our strategy forward really successfully. And on this first deal we just did, we've at least had a good execution that says, yes, that's realistic. We can do that, and we will do that.
Well, we got an opportunity to look at one of your deals, Lou, and we hope we'll get more of those.
That's the best way to end on this, Will, that we would love to have you guys think about seriously joining us as an investor. You bring a lot to the table, and we like all of our investors to bring value to the table also.
Well, thank you for that, Lou, and thank you for coming on the Minds Capital podcast.
Surely. Have a good day, guys.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also, check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraisers. See you in the next episode.